Toyota just made a move so sudden that even longtime industry watchers were caught flat-footed, and that shock is rippling through factories, dealer lots, and worker group chats right now. Late notices went out, production lines slowed, then stopped, and for hours there was no clear explanation from Toyota at all. No press conference, no reassuring language about seasonal adjustments, no calm framing, just silence. And that silence is exactly why this isn't being treated like a routine pause. When a company as conservative and process-driven as Toyota halts production abruptly, it's never random and it's never small. These decisions are planned weeks in advance, approved at the highest levels, and only executed when internal alarms are already blaring. What's especially unsettling is how unexpected the trigger appears to be. This wasn't announced alongside a major recall, it wasn't preceded by a public earnings warning, and it wasn't framed as a simple supply hiccup. Behind the scenes, the talk isn't about one missing part or a short-term logistics issue. It's about mismatches between what Toyota built for and what the market is actually buying right now. Regulatory pressure tightening faster than projected, and demand signals that suddenly flip direction. Analysts who thought they had Toyota mapped out are now quietly admitting that the red flags were there, just not where anyone was looking. Inside the workforce, the mood shifted almost instantly. Temporary workers were the first to feel it. Contracts paused, shifts canceled, hours cut without clear timelines. Full-time employees weren't laid off overnight, but that didn't calm anyone. In the auto industry, everyone knows the pattern. Production pauses turn into extended slowdowns turn into restructuring, and restructuring is where jobs quietly disappear. The fear spreads fast because once a plant stops running at capacity, every linked department becomes vulnerable. People start doing the math in their heads, counting weeks, watching badge-in numbers, wondering who won't be there next month. The models tied most closely to the halted lines are now under intense scrutiny. Some are high-volume vehicles that dealers assumed were untouchable. Others are hybrids and crossovers that were supposed to be Toyota's safe bet in an uncertain market. Trucks, SUVs, and electrified models are all being affected differently, but the common thread is imbalance. Too many of the wrong configurations, not enough of what buyers are actually signing for. Dealers are being told one thing publicly and something very different behind closed doors, including hints that certain trims or even entire nameplates may be quietly scaled back or phased out rather than restarted at full strength. On dealer lots, the impact is already visible if you know where to look. Inventory is piling up in awkward ways, rows of vehicles that shoppers walk past while asking for something that isn't there. Some dealers are testing quiet discounts, others are pulling incentives entirely, unsure whether replenishment is coming or if they need to preserve margin before conditions worsen. Trade-in values are wobbling because the moment production uncertainty hits, pricing algorithms react, sellers hesitate, buyers freeze, and the entire flow of the market slows down in a way that feeds on itself. The bigger question now is whether this is just a Toyota issue or a warning flare for the entire industry. Similar adjustments have already happened at other major automakers, but Toyota was supposed to be the exception, the steady hand that avoided dramatic swings. If even Toyota is being forced into abrupt stops, that suggests something deeper is shifting under the surface of the 2026 auto market. Forecasts that looked stable a few months ago are being revised in quiet analyst notes, not headlines, and those revisions aren't optimistic. Pressure from electrification hasn't gone away either. Rising costs, slowing EV demand, and regulatory requirements that don't bend to market reality are squeezing strategy from both sides. Toyota's long-standing wait-and-see approach to full electrification once looked wise. Now, critics are asking whether that caution has turned into a liability, forcing rushed decisions instead of controlled transitions. Even hybrids, once the unquestioned middle ground, are facing new competitive and cost challenges that Toyota can't ignore. What often gets overlooked is the domino effect beyond the factory gates. Parts suppliers, transport companies, port workers, and dealership staff all depend on steady production. When one plant slows, dozens of smaller businesses feel it within weeks. Communities built around these facilities know this story too well because layoffs rarely stay contained. They spread faster than anyone expects, especially when uncertainty replaces clear timelines. For current Toyota owners, the questions are immediate and practical. Resale values don't collapse overnight, but uncertainty changes buyer behavior fast. Some models will hold value better than others, especially those with consistent demand and stable production outlooks. Others may soften as buyers worry about future availability, updates, or long-term support. Maintenance and warranty coverage aren't disappearing, but parts pipelines can tighten when production plans shift, and that's something owners should be paying attention to right now. Buyers watching from the sidelines are facing a tough call. Buying now could mean locking in before another wave of disruption, or it could mean stepping into a market that's about to reprice itself. The key is learning to recognize panic pricing versus real opportunity, and watching for subtle signs like extended delivery estimates, sudden incentive changes, or dealer language that starts emphasizing last available units. The most unsettling part of all this is how little warning there was. Media narratives painted Toyota as insulated, almost immune, and that reputation masked the stress building underneath. When companies known for stability move suddenly, it's rarely the end of the story. Insiders aren't asking if more announcements are coming, they're asking when. If production doesn't restart on schedule, the best case scenario looks very different from the worst case one, and there's one key indicator that will tell us which path this is heading down, because once that signal appears, this entire situation could change everything, and what happens next may force Toyota to make decisions that until now were unthinkable, especially if supplier orders don't quietly resume in the background. That's the detail most viewers never hear about, but it's the earliest warning sign insiders watch obsessively. When Toyota stops placing forward orders for parts at normal volumes, it signals that management isn't confident enough to commit to a restart date. Suppliers feel that hesitation immediately, and once they scale back staffing or production themselves, restarting the entire system becomes slower, more expensive, and politically harder. That's when a pause stops being temporary and starts turning structural, even if no one says that word out loud. At the same time, internal forecasting models are being stress tested in ways they haven't been for years. Toyota's planning culture relies heavily on long-term stability assumptions, but those assumptions are colliding with consumer behavior that's becoming unpredictable. Buyers are delaying purchases longer, financing costs are reshaping what people can afford, and loyalty isn't as ironclad as it used to be when incentives disappear. The danger for Toyota isn't just lower volume, it's misallocated volume, building vehicles that sit while competitors adapt faster to shifting demand pockets. There's also a psychological element unfolding that doesn't show up in quarterly reports. Once workers, dealers, and even customers sense hesitation, confidence erodes. Workers begin updating resumes, just in case. Dealers stop ordering aggressively and start hoarding cash. Buyers wait for the next headline before committing. None of this requires a formal announcement to cause damage. It happens organically, and by the time executives address it publicly, the momentum is already moving in the wrong direction. What makes this moment especially fragile is timing. This halt didn't occur during a clear recession or an obvious crisis where expectations were already low. It happened during a period that was supposed to be transitional but manageable. That contrast is why fear escalated so fast. People weren't braced for disruption, so when it arrived without warning, it felt amplified. And in the auto industry, perception often moves faster than reality, but perception still drives real decisions. Behind closed doors, contingency planning is accelerating. Scenarios are being modeled that include staggered restarts, partial shifts, and selective model prioritization rather than a full return to previous output. Those plans don't usually exist unless leadership believes normal conditions may not return quickly. Even optimistic internal outlooks now come with caveats, and when caveats multiply, they tend to become policy. For viewers trying to make sense of all this, the key takeaway isn't panic, but awareness. This isn't about one factory or one model. It's about how quickly stability can fracture when multiple pressures converge at once. Toyota's strength has always been discipline and patience, but the current environment is punishing slow adjustments and rewarding flexibility. Whether Toyota can pivot without damaging its workforce, dealer network, and brand trust is the question hanging in the air right now. And as the days pass without clear confirmation, each hour of silence adds weight. Because in this industry, the most dangerous words are never spoken loudly. They're whispered in meetings, buried in forecasts, and delayed until the moment when the decision has already been made. And once that moment arrives, everything connected to it starts moving faster than anyone outside expects, setting the stage for what could be the next shock that no one sees coming, especially if the next update reveals, continue script do not end. Especially if that next update comes not from Toyota itself, but from the ripple effects around it. Often, the clearest confirmation doesn't arrive as a press release. It shows up as leaked shift schedules, canceled logistics contracts, or dealers quietly told to plan conservatively for the next quarter. Those indirect signals are already being watched closely because they tend to surface days or even weeks before an official acknowledgement, and once they appear, the internal narrative hardens fast. Another layer making this situation more volatile is how quickly sentiment can turn in today's market. Social media, worker forums, and dealer networks spread information instantly, accurate or not, and uncertainty fills the gaps left by silence. When people don't have facts, they assume the worst. That assumption alone can change behavior in ways that deepen the problem, from employees disengaging to buyers postponing purchases they would have made just months ago. There's also the financial side that hasn't fully surfaced yet. Production halts don't just affect revenue, they disrupt cost structures. Fixed expenses keep running while output slows, squeezing margins in ways that aren't visible until later earnings calls. By the time those numbers are discussed publicly, decisions about staffing, capacity, and future investment are often already locked in. That delay between cause and disclosure is why sudden halts are so unsettling to people who understand how the industry really works. What's especially striking is how this challenges long-held assumptions about safety in the market. Toyota has long been treated as a defensive brand, one that could weather storms better than most. If that perception cracks, even slightly, it changes how investors, suppliers, and consumers allocate trust. And once trust starts shifting, it doesn't snap back overnight. It takes consistent action, clear communication, and time, all of which are in short supply during moments like this. As uncertainty lingers, internal conversations naturally shift from when things normalize to what if they don't. That's when companies begin rethinking product mix, regional focus, and workforce size in more permanent ways. Those conversations don't mean collapse is inevitable, but they do mean the status quo is no longer assumed. For employees and communities tied to these facilities, that shift in mindset can be more destabilizing than any single announcement. For viewers following this closely, the coming period matters more than the initial shock. The next few weeks will reveal whether this halt was a tactical reset or the first visible crack in a much larger adjustment. Watch how often restart timelines move, how dealer messaging evolves, and whether related industries begin signaling stress. Those clues will tell a clearer story than any carefully worded statement, because once a company reaches the point where multiple backup plans are being prepared simultaneously, it's usually responding to forces bigger than a short-term disruption, and if those forces continue building pressure without relief, the decisions that follow won't be about trimming around the edges, they'll be about reshaping priorities entirely, which is why so many people inside and outside the company are bracing themselves right now, waiting to see whether the next move confirms fears or triggers an even deeper shift that could redefine what stability in the auto industry really means, especially as broader economic signals start aligning in uncomfortable ways. Interest rates remain elevated longer than many expected, consumer credit is tightening, and affordability is quietly becoming the defining constraint of this cycle. Even buyers who want to purchase are being forced to step back, reassess, and wait. That hesitation compounds inventory issues and makes production planning feel like aiming at a moving target, something even Toyota's famously precise systems struggle with. At the same time, competition hasn't slowed. Rival automakers are making aggressive moves to protect market share, some cutting prices, others slashing output preemptively to avoid being caught with excess stock. This puts Toyota in a narrow corridor where every decision has trade-offs. Cut too much and risk losing relevance in key segments. Produce too much and risk a glut that erodes pricing power. The halt signals that leadership believes the downside risk of overproduction has suddenly outweighed the cost of stopping, a calculation that rarely happens without strong internal justification. What's unfolding also raises questions about how quickly the workforce can be stabilized even if production resumes. Morale doesn't reset with a restart button. Once uncertainty seeps in, productivity, retention, and engagement all take a hit. Skilled workers start exploring options elsewhere, and replacing that experience later is far more expensive than keeping lines running in the first place. This is why prolonged pauses are so dangerous, not just financially, but operationally. operationally. For dealers, the challenge is equally complex. They're caught between manufacturer guidance and local market reality. Some are being advised to hold firm on pricing, others to move metal while they can. That inconsistency creates confusion on the ground and makes buyers suspicious. When two dealerships give completely different messages about availability or future supply, shoppers assume someone isn't being honest, and trust erodes again. Zooming out, this moment may mark a subtle turning point in how safe brands are perceived. If Toyota, with its deep reserves and conservative strategy, can be jolted this abruptly, then no manufacturer is insulated from the volatility reshaping the auto landscape. That realization alone could accelerate changes already underway, from how factories are staffed to how vehicles are marketed and priced. And then there's the political and regulatory layer that hasn't fully come into view yet. Emission standards, electrification mandates, and trade policies are all moving targets. Planning for compliance while demand shifts unpredictably forces automakers into uncomfortable compromises. Decisions that look purely economic on the surface are often entangled with regulatory timing and incentives behind the scenes, adding another layer of pressure to already strained operations. All of this converges into a situation where waiting becomes its own risk. Every day without clarity increases the odds that temporary measures harden into permanent changes. That's why insiders aren't just watching for restart announcements, they're watching for tone, language, and small operational signals that reveal how confident leadership really is. Because confidence, once lost, is the hardest thing to rebuild. And as this story continues to develop, one thing is becoming increasingly clear. This halt isn't an isolated event, it's a symptom, a signal that the balance the industry relied on for years is shifting faster than expected. What happens next will depend on how quickly that reality is acknowledged and addressed. Because if it isn't, the next phase won't arrive gradually. It will arrive suddenly, reshaping jobs, pricing, and consumer behavior in ways that will feel shocking in hindsight, especially when the next announcement drops and reveals just how deep these adjustments were all along and why. Why so many people inside the system felt uneasy long before the public ever noticed. In hindsight, there are always clues. Meetings that get rescheduled without explanation, budgets that tighten quietly, long-term projects that slow down temporarily. None of these things make headlines on their own, but together they paint a picture of an organization bracing for impact rather than coasting forward. And that's the uncomfortable truth emerging now. This wasn't a sudden storm. It was pressure building beneath the surface until something finally gave. What makes moments like this especially dangerous is how quickly they can redefine expectations. Once the idea takes hold that production stops are possible at any time, planning across the entire ecosystem becomes more conservative. Suppliers hesitate to invest. Dealers resist expanding. Workers think twice before committing long term. Even customers begin questioning availability and future support. That collective hesitation can slow recovery even if demand stabilizes, because momentum, once lost, is hard to regain. There's also a generational shift happening in buyer behavior that complicates everything. Younger buyers are less brand loyal, more payment sensitive, and more willing to delay or opt out altogether. Toyota built its dominance on trust earned over decades, but trust alone doesn't overcome affordability limits or uncertainty about the future. If buyers believe prices may fall or models may change soon, waiting feels like the safest move, and waiting is the enemy of steady production. Inside boardrooms, this forces difficult conversations about priorities. Do you protect volume at the expense of margin, or margin at the expense of scale? Do you preserve jobs now and risk deeper cuts later, or make smaller, earlier reductions to avoid a larger collapse? These aren't theoretical debates. They shape real outcomes for real people, and once decisions tilt in one direction, reversing course becomes politically and operationally painful. What viewers should understand is that industries don't shift because of one bad decision. They shift because conditions change faster than institutions can adapt. Toyota's halt is a data point in a much larger pattern of recalibration that's happening across manufacturing, finance, and consumer markets at the same time. The reason it feels shocking is because the narrative lagged behind reality. As this recalibration continues, the gap between what's said publicly and what's prepared privately may widen. Companies often choose optimism in messaging even while preparing for downside scenarios internally. That's not deception, it's risk management. But it does mean the public usually learns about the depth of change only after the most consequential decisions are already set in motion. So as everyone waits for clarity, the smartest move isn't blind optimism or panic, but attention. Watch how quickly timelines firm up or slip slip again. Watch how incentives change week to week. Watch whether communication becomes more frequent or more vague. Those patterns will tell you far more than any single announcement. Because if the next phase confirms what many insiders already suspect, this moment will be remembered not as a temporary pause, but as the inflection point. The moment when stability quietly gave way to adjustment, and adjustment gave way to transformation. And when that realization fully sets in, the question won't be whether anyone saw it coming, but whether anyone was truly prepared for what comes next, especially as the industry moves into a phase where decisions made in silence today determine outcomes that will dominate headlines tomorrow, and the consequences of those decisions begin to surface in ways that no press release can soften, particularly if consumer confidence takes another unexpected hit. Confidence is the invisible fuel of the auto market, and once it drops, even strong incentives and trusted brands struggle to move inventory. People don't just buy cars based on need anymore. They buy based on timing, perceived risk, and fear of making the wrong decision right before prices fall or models change. If hesitation deepens, production planning becomes even more fragile, because forecasts rely on behavior that no longer follows old patterns. There's also the matter of financing pressure that hasn't fully played out yet. Monthly payments have become the real price tag for most buyers, and when rates stay high, demand doesn't disappear evenly, it fractures. Entry-level buyers vanish first, then mid-range shoppers pull back, leaving only higher-income customers who are far more selective. That skew can make sales numbers look deceptively stable while masking a shrinking base underneath, forcing automakers to react abruptly when the imbalance becomes impossible to ignore. Internally, that kind of imbalance creates a constant tension between optimism and realism. Sales teams push for confidence. Operations teams warn about overcapacity. Finance teams model worst-case scenarios no one wants to talk about publicly. When a halt finally happens, it often means those internal debates reached a breaking point and realism won. That's why these moments feel sudden from the outside but overdue to those inside the system. Another risk quietly emerging is competitive repositioning. When one major player slows, others test the boundaries. They adjust pricing, flood certain segments, or pivot messaging to capitalize on uncertainty. That can box a cautious company into even tighter corners, where waiting becomes more expensive than acting, even if acting means stopping lines and absorbing short-term pain.